DOHOME's profit just fell significantly short of expectations, showing a sharp contraction in profit from sales. Welcome to your personalized deep dive brief from Inside AI Setai. Today we're talking DOHOME stock. We're going to peel back the layers, really understand what's driving its performance. And DOHOME's recent Q2 numbers for 2568, they've certainly got people talking. So let's unpack these figures. They tell quite a story, I think.
Absolutely, and it's a bit of a challenging story in parts. So for Q2 2568, net profit came in at 157 million baht.
Okay.
Now that's not just a little off; it's down 18% compared to last year, and even more sharply down 36% from the previous quarter.
Wow, 36% quarter on quarter.
Yeah. And what's really telling is that it missed estimates. It was 17% below KGI's forecast and 11% below what the broader market was expecting.
So analysts are definitely caught off guard a bit there. What did this dip in profit mean for, the top line? How did overall sales and revenue look?
Well, total revenue for the quarter was 7,359.63 million baht. That's down 9.0% year on year. And if you look specifically at sales and service revenue, that dropped 9.1% year on year, down to 7,282.77 million baht. The main drag there was weaker performance from their existing branches. Same-store sales were down.
Right, so the established stores weren't pulling in as much business.
Exactly. And looking at the whole first half of 2568, it's a similar picture, really. Net profit for those 6 months was 402 million baht. That's an 8% decrease year on year.
Okay.
And total revenue for H1, 15,491.32 million baht, which is down 3.8% compared to the first half of last year. So the Q2 slump wasn't, a one-off. It fits the trend.
Now, this is where it gets really interesting for me. Management pointed to a few things behind this performance. What were the key factors they highlighted? What stood out?
Well, they definitely flagged the overall economic situation in Q2, both internal and sort of external pressures, weakening purchasing power. That was a big one. They also mentioned the rainy season starting earlier than usual. That always hits construction-related sales.
That makes sense.
But, and this is important, despite those headwinds, they did manage to improve internally. They worked on their cost of goods, operational efficiency, things they could control.
That's fascinating. Sales down, but they're tightening the belt and actually seeing margin improvement in some areas. Is that about shifting product mix or just pure cost control?
It seems like a bit of both, actually. Despite the sales drop, the gross profit margin edged up slightly to 18.0% in Q2. That's up from 17.5% in the same quarter last year.
Okay.
And that improvement came mainly from better margins in construction and repair products.
Right.
Looking at the whole first half, the gross margin was 17.8%, up from 17.6% year on year. So, yes, they managed some margin improvement across the board, better product mix, probably smarter buying.
Interesting. And what about other costs? Selling, admin, finance?
Yeah, they managed those too. Selling and admin expenses actually dipped slightly. 0.4% year on year in Q2, mostly cutting back on variable costs like marketing, utilities.
And finance costs saw a really significant drop, down 25.2% year on year in Q2 and 21.8% for the first half. That reflects lower interest rates, sure, but also they've reduced their debt load somewhat.
So some positive signs on the cost management front, even with the sales pressure. Now, we often talk PE, EPS, PBV, but what about overall financial stability? Anything else stand out?
Well, the reports we looked at didn't give specific Q2 figures for PE, EPS, or PBV, but a really key metric is the debt-to-equity ratio, the DE ratio.
Yeah.
At the end of Q2, it stood at 1.6 times.
1.6. Okay, so what does that tell us?
Well, anything over 1.0 means more debt than equity. So 1.6x suggests they're, fairly leveraged, relying more on borrowing. It's not necessarily a red flag on its own, but it does indicate a, let's say, tightening balance sheet, makes those cost savings even more vital.
Got it. So moving beyond the numbers then, let's talk about their plans, their strategy. For you listening, you're probably thinking, okay, things are tough. What's DOHOME actually doing about it? Right. Well, first, their physical footprint. As of Q2, they have 40 branches total. That's 24 of the big XL and L format stores and 16 of the smaller DOHOME Togo outlets.
And wasn't there a target they set a while back?
Yes, exactly. Back in 2021, they aimed for 36 branches by 2025. So they've actually already surpassed that target. Quite aggressive expansion.
Okay, hold on. Exceeding expansion targets, but we just talked about a DD of 1.6 and a tightening balance sheet. How does that square up? Is that expansion push sustainable right now?
That's a really sharp question. And it points to how they've shifted strategy. They haven't just been buying land outright for every new store. They've moved more towards long-term leases for land.
Ah, okay. Less upfront capital needed.
Precisely. It lets them grow faster without tying up so much cash. They've also invested in things like adding air conditioning to branches, which helps the customer experience, and using high-rise warehouse systems in the bigger stores to be more efficient with space. Better inventory management.
Makes sense. And what about pure cost-cutting operational stuff?
Oh yeah, they've been busy there too. Switching to IP phone systems, partnering with Kazakhstan Bank for financial management efficiencies. And a big one, installing solar rooftops on all branches.
Solar. How much does that save?
They estimate around 4 million baht a year just on electricity. So these aren't just tiny tweaks, they're looking for real structural savings.
Okay, so clearly trimming costs wherever possible. What about driving future growth? Any new initiatives, new directions they're exploring?
Definitely. They're investing in their people with a learning management system and LMS. And interestingly, they're using what they call virtual employee robots.
Robots? Like actual robots?
No, not physical ones. Think software bots.
Yeah.
AI-powered automation for routine, repetitive admin tasks.
Okay. RPA.
Exactly. Frees up their human staff for more complex work. They're also using CRM tools for better marketing, diversifying product lines like adding elderly care products, tapping into Thailand's aging population trend, and importantly, running promotions to shift slow-moving stock, get that inventory moving, free up cash.
Right, clearing out the old stock makes sense. So looking ahead then, what's the outlook for Q3 and beyond, according to management?
Well, they're cautious about Q3. They expect profit will likely dip compared to Q2. Partly seasonal, partly continued weak demand. Same-store sales are apparently already contracting in the mid to high single digits so far this quarter.
Oof, not great.
No, but they do expect a year-on-year increase for Q3 profit, mainly because Q3 last year was a particularly low base to compare against.
Right.
And there's some hope for a potential profit recovery in Q4, but, that remains to be seen.
Which brings us right back to that key question you might be asking. Why is the stock price struggling if they seem busy, expanding, innovating, cutting costs?
It's a great question, and the answer lies partly in how DOHOME makes its money. It's quite different from, say, a Home Pro or a Global House, even though they seem like competitors.
How so?
About half, roughly 50% of DOHOME's customers are contractors and dealers. It's a significant B2B, business-to-business component, more like a wholesale or cash and carry for building stuff, less purely retail.
Okay, that is a key difference. And that B2B focus makes them more sensitive to certain things.
Exactly. Government spending, for instance, public construction projects. Delays in government budgets over the past year have directly hit demand from those contractor customers. That's a major headwind for DOHOME specifically.
Right. And wasn't there something about steel prices too?
Yes, absolutely. Over 30% of their sales is construction steel. And right now, there's a global oversupply, partly due to China's property market slump. So steel prices have fallen.
And DOHOME holds a lot of inventory.
Bingo. They keep large stocks, like 90 days worth, to make sure contractors can get what they need immediately. But when market prices fall, they have to sell their existing, more expensive stock at lower prices. That crushes margins on that inventory. It could even lead to write-downs.
So a double whammy from the B2B side. Lower government spending and falling steel prices hitting their inventory strategy.
Precisely. And layered on top of that are the broader industry issues. Analyst reports from around June were pointing to weak overall purchasing power. A big drop, like 50% quarter-on-quarter in new property project launches after a recent earthquake.
Right, I remember that.
The early rainy season hitting foot traffic, political uncertainty delaying budgets further, and just generally tougher price competition everywhere, online and offline.
Wow. It really does sound like a perfect storm, doesn't it? External factors, industry factors, specific business model vulnerabilities, all hitting at once. Is there one thing that feels like the biggest hurdle for them?
It's hard to pick just one, but I'd say that combination of weak general demand plus the specific hit to their core B2B segment from those government delays and the steel price volatility. That seems critical. These are big external forces. Their internal efficiencies help, but they can't fully offset that kind of macro pressure given their business mix.
Okay, so with all that context, the performance, the plans, the pressures, let's look at what the financial analysts are saying. Have their views changed much?
Oh, dramatically. It's been a real roller coaster. If you go back to February this year, 2568, you had Dow Securities with buy rating.
Okay, positive then.
Very. They had a target price of 9.50 baht.
Yeah.
And they were forecasting 29% profit growth for DOHOME for the year. Really quite bullish.
9.5, wow. Fast forward a few months though.
Complete turnaround. By June, and then confirmed again in August, both KGI Thailand and Dow Securities, the same firm, remember, had switched to a sell recommendation.
A sell from a buy.
Yes.
Yeah.
And the new target price, 2.60 baht.
That's a massive downgrade from 9.50 to 2.60. What drove such a drastic shift?
Well, Dow's June downgrade report hit on all the things we've discussed. Weak purchasing power, the early rains, political factors delaying projects. They slashed their 2568 profit estimate for DOHOME by 26% and flipped their same-store sales assumption from growth to a 5% contraction. It was a fundamental rethink.
So not just tweaking numbers, but seeing the whole picture differently.
Exactly. And there's a broader analyst view emerging too. They're starting to talk about the whole home improvement sector, moving out of a high growth phase and into a more mature stage.
Okay, what does that mean in practice?
It means valuations get re-rated. Analysts are now applying lower PE multiples, maybe around 11.5x for the sector. They're saying the previous multiples of 20x, 30x, or even higher were justified for growth, but not for a mature industry facing these headwinds. So the goalposts have moved for the whole sector, not just DOHOME.
That makes sense. So with all this volatility, the downgrades, what about dividends? For an investor maybe looking for income, is DOHOME still a reliable payer?
Well, their official policy is to pay out at least 30% of net profit, calculated from their separate financial statements after tax and reserves. But, and it's a key but, the actual payout can change.
Based on what?
Based on performance, obviously, but also financial liquidity, cash flow needs, their overall financial health, and critically, how much capital they need for expansion or other investments. So there's flexibility built in for the company.
Have they been consistent historically, though?
Actually, yes. Looking back, they do have a record of pretty consistent payouts. Often it's been a mix of stock dividends and cash dividends.
A mix? How does that work?
So for the 25-67 fiscal year, for instance, they paid a stock dividend. Shareholders got one new share for every 21 they held, plus a cash dividend of about 0.0476 paid per share. The year before, 25-66, it was similar, a 22.1 stock dividend and around 0.0455 paid in cash.
Interesting. So they give shares in cash.
Yeah. It shows a commitment to returning value, but the stock dividend part also helps the company hold on to cash, which is smart when things are tighter, they need capital. Of course, for the shareholder, getting more stock means you own more of a company whose price is currently under pressure. So it's a mixed blessing, maybe.
Right. Okay, let's pivot to the charts. For those of you who follow the technicals, you're probably wondering about support, resistance, patterns. What does the DOHOME chart tell us as of, say, today, August 21st, 2568?
Yeah, unfortunately, this is where the source material we have is quite limited. We don't have enough data for a full technical deep dive.
Oh, what do we have?
We have a snapshot from one specific day, August 7th, 2568. On that day, the stock price fell 5.02% to close at 4.16 baht. Trading volume was about 81.8 million baht. It opened at 4.26, hit a high of 4.28 and a low of 4.1.
So just one day's action.
Pretty much.
Anyway.
And while that sharp 5% drop certainly tells you something about recent volatility and selling pressure,
Sure.
it doesn't give us the bigger picture. We can't see historical trends. We can't identify clear support or resistance levels over time. No obvious chart patterns like head and shoulders or flags or anything based on this limited data for the period up to August 21st.
So trying to trade just off that one data point would be risky.
It's truly risky. It's like reading one word on a page and trying to guess the whole story. It really underscores why you need both sides. The fundamental analysis, the why, behind the company's performance, which we've dug into, and proper technical analysis from more complete chart data, which shows the how and when of market sentiment and price action. You need both for informed decisions.
That's a really crucial takeaway. You need the full picture. We've covered a lot today: DOHOME's Q2 performance, their strategic moves on expansion and costs, the B2B pressures, the dramatic analyst shift, the dividend history, and the limitations of the chart data we have. So as we wrap up, here's something to think about. We see DOHOME battling these headwinds, adapting, managing costs. In a market often obsessed with pure growth, are we sometimes too quick to dismiss companies navigating a shift to maturity, especially when facing this perfect storm? Or is DOHOME's specific business mix just too vulnerable to these external factors right now? Definitely food for thought. If you have any other stocks you'd like us to dive into, please do let us know. And don't forget to like, share, and subscribe. It really helps support our team. Thanks for joining us on this deep dive.